Hello, we're on to chapter 4 now of the textbook. This chapter you will really see, if you haven't seen already, how our material builds in accounting. So each chapter as we complete it, if you're not clear of something, you should go back and you should look at the PowerPoints again, or maybe read the textbook, or send me your emails about things that just don't seem to make sense, because if you don't understand something at one point, usually we will go back to that same topic again, and you may not understand the next concept. This chapter, for example, we're going to go back and we're going to start talking some more about the concepts of revenue and expense, and we're also going to be talking about the accrual process, or accruals and deferrals. You'll have a series of PowerPoints associated with this chapter, and this is just the first PowerPoint for Chapter 4. After Chapter 4, we're also going to change the order in which we do things this semester, so you may need to check, because I believe we'll be on to Chapter 12. So Chapter 12 will follow Chapter 4 and not Chapter 5. So this PowerPoint and this portion, this video portion, is just about really the first concept about why adjustments are needed. And we will then go on to the next PowerPoint where we will actually do the adjustments. A little bit in this PowerPoint also about the relationship between adjustments and financial statements, which is 4. Objective 4, and then learning Objective 6. The closing process, which we'll get to, is not a difficult process at all. You've already also had some exposure to trial balances, so learning Objective 3 should also not be an issue. So you may need to spend a little more time on the second videos for this particular PowerPoint. That would be your emphasis probably in Chapter 4. Why do we need the adjustments? Well, we learned from a previous chapter that we have these rules about recording revenue and expense, and we said, keep returning to these rules, that to record revenue you have to have earned it, right? You have to have done something that shows the producing or the productive process of your company and that you're very effective at it. It shows up in revenue. And then we have an expense rule which says you record expenses when those expenses are incurred, and then we went into matching. Well, the difficulty here is if we don't do adjusting entries, we may not record our revenue and expenses. And then the other thing up here, which I note here, is the balance sheet should reflect the proper asset values, liability values, and it also should have the equity, which comes from net income. So the main reasons why we have to do these adjustments is to get the balance sheet and the income statement right. And sometimes we lose track of what we're doing or where we're going. It's like you're going down a road and what's the destination? And the destination in accounting, for financial accounting, which this is a class in, is to get to those financial statements. So you want to get to the financial statements, you want the values to be right. And we talked about what assets are, we talked about what liabilities are. So a person who reads the financial statements needs to see if the asset still exists, it should be on there. If it doesn't exist, it shouldn't be on there. And if we owe someone through a liability, it should be reflected also. So the balance sheet has to be right, the income statement has to be right, and to make things right, we do things called adjustments, and we call them adjustments, and it's also called adjusting entries. So these adjusting entries are to get the balances in the ledger to reflect the application of GAAP, which is the last statement on this slide. So if you're following along with paper copies, you might want to highlight that. The whole point in why we do this is to get the balances right so the financial statements are right. And the reason why we have to do it is because at present, if we followed those rules for recording revenues and expenses, they aren't always in agreement with the cash basis, and we had this in a previous chapter as well. So we may have to have two journal entries to get everything right. We have a cash transaction, and then we have a revenue or expense transaction. And the cash transaction first is called a deferral, and if you do the cash transaction last, it's called an accrual. And this is just the terminology of the thing. Okay, so we have deferrals and we have accruals. And we call GAAP the accrual basis of accounting, just as a means of saying that we are not recording things based on when the cash transfers, but we are recording things based on our revenue and expense rules. Remember, revenue when you've earned it and you expect to collect at some later point, and expense when it's incurred or when it matches up to revenue. Now, why again do we need to have these adjustments? To make sure we have the proper balances. So if you have prepaid assets, let's say you go out there and you buy insurance, and your insurance is for a year. After 1 month's time, you no longer should have on your books this prepaid asset that reflects the whole year. You should have a prepaid asset that reflects 11 months of the asset that are remaining. So this is an example of that. We will go through some examples of the adjustments. We'll do journal entries in the second video, or the part 2 of PowerPoint 4 videos. So the problem again is cash doesn't always happen when the company earns revenue or incurs the expense. And the solution is to make adjustments. The adjustments are going to have to be done then before we do our financial statements, because the financial statements will be out of order. And again, going back to our concepts of what is in the income statement and what revenues are, what expenses are, and what is on the balance sheet, and the definition of the assets and liabilities, and what we should show when we get to these financial statements. Now, if you do have cash coming in before a revenue or expense item, then you are going to have to record the cash because the cash comes in, and you are going to what we call defer a revenue or expense. So an expense or revenue has been deferred if we postpone. So it's the terminology, you can keep it straight in your head if you think about it. What we are talking about here is when expense or revenue is recorded. If you wait, it's deferred, okay? And if you wait on revenue or expense, then what you're going to do today is record the cash. So here we are paying our rent in advance. Previous example I had for you was paying insurance. Here you're paying rent in advance. Cash was paid for rent in advance. We get to use up the benefits associated with this rent during the month of September, and so at the end of September we need to reflect that we no longer have these benefits which are owed to us from the rent. Okay, another example of, so the first one is talking about expenses, and you are going to have a deferral here because your expense does not really occur until after the month of September, not at the beginning, but at the end, through September technically. In the second one, we're talking about revenue. And let us say that you are a company that delivers game downloads. If you receive the cash before you have actually provided the downloads, you cannot record it as revenue at this point, at September 1st. However, your revenue would have been earned as you delivered those downloads. So when you do your financial statement at September 30th, you need to make sure that you are recording revenue for the fact that you've provided that service. Now, companies will tend to want to record revenues because revenues are good things. So when a company does these adjustments, which are required, there'll be a tendency for them to try to do the second one, where we are going to record revenue, and they are not going to really want to do the first one, which is recording expense. However, following GAAP, you have to do this. You have to record the revenue coming in the proper time period, when the work is done, when it's earned, and you have to record the expense in the proper time period. Now, when you do these transactions and the cash happens first, so you are deferring, you will either have an asset when you pay cash or a liability when you receive cash. And then what you're going to do is you're going to remove each one of those at the end of the time period. So here are some examples then. If you buy supplies and you use up your supplies, then you will not have the supplies at the end of the time period, so your supply balance needs to be changed, and you have to recognize this expense, which is for using up the supplies. The prepaid rent, the prepaid insurance we have just discussed. The unearned revenue, that's what we call getting in cash when we haven't done anything. And we said in a previous chapter this is a liability. When we actually do the work, we remove this liability and we create the revenue. The opposite of a deferral is an accrual. Again, I want you to focus in on these, on revenue and expense. Accrue means you want to record it. You have to record it now. So you want to accrue, you want to put it in now. So whereas deferrals, you wanted to put in the revenue or expense later, accrual means you want to put that in now. And if you're putting the revenue and expense now, these adjustments occur because the cash is only going to come at a later period of time. So the cash will be received or paid at a later time. So you think about deferrals and you think about accruals as opposites. They both come about because of a problem. The problem is that revenue and expense don't happen at the same time as cash flow. In the first one, we can all relate to this. It's income taxes. Now, you know that income taxes are related to net income. So, if net income happens over this time period from September 1st to September 30th, then it's proper for us to, at the end of September 30th, show income taxes. But we may not pay our income taxes until a later time period. Some of you probably paid your income taxes on April 15th, for example, and you paid your taxes on April 15th related to the previous tax year, which ended December 31st. So that was an example of this first one here. You incur your income taxes as you provide revenue, as an expenses are incurred, and you actually pay for it at a later point in time. Okay, so you need to record some sort of adjustment on September 30th. Now, here we have a revenue transaction, and we are earning revenue from promotional services. So we're doing things, but we actually are not receiving the cash in until later on. So you need to change this. It is not the expense happens here. It should say the cash happens here. Okay? So the cash is actually received at this point in time. This should be familiar to you. This is the sort of thing you do in a business when you record an account receivable, and then the cash actually comes in on December 31st. So the accrual and the deferrals have to do with the timing of whether the cash comes first or whether the revenue or expense comes first. when you have an accrual and you're recording things and it's an asset, so you're going to be receiving this cash later, you call it a receivable because it's going to be received in the future. You're going to receive that cash later. And when you're going to pay something later, you call it a payable. So you're going to say, I'm going to pay my income taxes later. So the initial time period when you show that income tax expense should show up on your financial statement, you'll show it as a payable. And that payable then will go away. Now that's going to be the end of this particular PowerPoint. When we go on to the next one, we will go into actually preparing adjustments. And we will go through doing our journal entries. We'll talk about the debits, the credits. We'll go back to T accounts, and we'll work on that.